Hey friends, Iggy here. Today's episode is a trade war red alert for Singapore investors. This isn't just another tariff headline. China has played its ace card with rare earths, and it changes the game. Let's walk through this together, section by section, so it's clear what's happening, why it matters, and how to position portfolios without stress. If you're new here, I've spent years breaking down investing in Singapore so investors don't have to guess. By the end, there'll be a simple checklist: what to buy, what to avoid, and how to think about risk when narratives get loud. So here's the hook. You've seen the tariff back and forth all year. It felt almost routine. Then in October, Beijing didn't just add tariffs. They tightened control of rare earths and extended rules that make any product using even a tiny bit of Chinese rare earth subject to Chinese approval. What does that really mean for us? Let's map the journey first. The rare earth reality check. The tariff time bomb, Singapore's market response, winners and losers, the deeper strategic implications, what this means for portfolios right now. All right, first up, the rare earth reality check. China doesn't just mine these materials. They own the processing. They hold much of the know-how, and now they are setting the export rules. If you're thinking, Iggy, how big is this? Imagine a table in front of you that says China handles about 9/10 of global rare earth processing and around the mid-80% of magnet production. Those magnets power EV motors and wind turbines. The rest of the world is a small slice. That's a bottleneck, and bottlenecks mean leverage. Here's the simple way to see it. If China tightens shipments or requires licenses for products using their materials, companies worldwide might wait, redesign, or pay more. EV makers, wind turbine builders, chip makers, many depend on these elements. So when Beijing adds more elements to the control list, think names like dysprosium, terbium, europium, it isn't trivia. These elements sit in motors, screens, fiber optics, and if one part of the chain slows, the whole product slows. That's why this moment feels different. Now the tariff time bomb. The pace of escalation this year has been fast. Think of it as a ladder. Auto tariffs, retaliations, a broad universal tariff, then jumps to triple-digit effective rates. In October, there was a threat of another huge step up, enough to push total duties into a 245% if fully stacked kind of range. When that kind of threat hits, markets don't shrug. We saw a big down day, and that wasn't about vibes. It was about cost structures, margins, and confidence. But here's the key distinction. In past trade flare-ups, we were arguing about finished goods. TVs, shoes, phones. Painful, but you can shift factories over time. Rare earths are different. Processing is concentrated. Building new refining capacity and supply chains is slow and expensive. So the market's telling us this could linger. Makes sense, right? That brings us to Singapore's market response. The STI has been a tank this year relative to the noise, still up solidly on the year in spite of the volatility. But when you zoom in on sectors, a pattern appears. Imagine another table. On the left, sectors. On the right, how they're doing and why. REITs, holding up as a defensive haven. Telecoms like Singtel, benefiting from investors seeking steady cash flows. Banks, mixed. Great year-to-date performance, but some institutional money stepping back as growth jitters rise. Industrial REITs, feeling it, because logistics get hit when supply chains slow. Tech hardware across the region, volatile, and more sensitive to rare earth bottlenecks. Now, why does this rotation matter? Because it shows where capital hides when the story turns from trade spat to strategic choke point. Defensive yield, stable cash flows, domestic exposure, those traits suddenly look attractive. Honestly, this is where many investors trip up, staying wed to a narrative after the regime has shifted. If the constraint moves from tariffs on shoes to export approvals on EV magnets, risk lives in a different part of the market. Make sense? Let's unpack the tables in plain English. The rare earth dominance table says China controls most processing and magnet output, which means they hold the valve for EVs and wind. The export controls table says more elements added, more sectors affected. Healthcare imaging, displays, fiber optics, motors. The tariff timeline says higher and faster escalation than the last cycle. The Singapore performance table says defensive sectors outperform when the world goes risk off. The winners versus losers table says REITs and telecoms are holding ground. Industrial logistics, REITs, and China-exposed names face headwinds. Tech hardware is jumpy because of supply chain inputs. Now this is where it gets interesting for Singapore investors. Our economy is trade-heavy. We benefit from flows, logistics, and regional demand. But when a strategic input gets constrained, shipping volume expectations can wobble. Industrial REITs and logistics-linked plays may need a margin of safety. Meanwhile, domestic, necessity-like cash flows, think large integrated commercial REITs or healthcare REITs, don't rely on global goods moving smoothly. That's why they tend to act like ballast. So, what's the practical takeaway at this point? If the rare earth situation persists, it's rational that the market continues to reprice anything dependent on that chain. And investors overweight tech hardware or China-exposed REITs might consider trimming risk, rotating into stable yield with domestic durability. By the way, if you want all the reference tables and the written version, everything's on Substack. The link's just below. Let's dig into the deeper strategic implications. This isn't just economics, it's geopolitics and technology policy. For decades, the world allowed China to specialize in rare earth processing because it's messy, complex, and capital intensive. Unwinding that in a hurry is tough. The new control rules, especially when they touch products with even a small fraction of Chinese content, create a compliance maze. Companies might redesign, source from alternative refineries, or accept delays. None of that is overnight. For Singapore, there's nuance. As a hub, we can benefit from trade diversion. Some routes will shift as firms try to avoid tariffs. But if overall global trade slows, we still feel the chill. And in sectors like semiconductors or renewables, rare earth inputs are key. That's why the best stance is controlled offense. Own what's resilient, watch what's exposed, keep dry powder for dislocations. All right, let's bring this back to the portfolio moves. Here's my honest take. When policy risk targets the raw inputs of future tech, investors should prioritize cash flow durability over blue sky optionality. If I could give one thing to remember, in supply chain shocks, boring's beautiful. Defensive REITs with strong tenants and long leases, good ballast. Telecoms with steady dividends, useful anchor. Banks, great franchises, but be mindful of cyclical nerves and funding dynamics. Industrial REITs and China-centric names, keep them on a shorter leash until there's clarity on supply flow and demand. And for the more tactical folks, consider phased moves. No need to yank the wheel. Trim, rotate, rebalance. If valuations and defensives haven't run too far, add on weakness. If riskier names bounce on headlines, use it to lighten exposure. And keep an eye on dividend coverage, lease expiries, and currency exposure. Simple, steady, repeatable. Quick recap before we close. China's rare earth move is the sharp end of the trade war because it controls the inputs, not just the outputs. The tariff ladder adds cost and uncertainty on top. Singapore's market is rotating toward defensives. REITs and telecoms are holding up. Logistics, China-exposed REITs, and tech hardware feel the pressure. The strategic story suggests this won't resolve overnight, so a durable, income-first posture makes sense while the dust swirls. So, if planning the next move, here's what I'd keep in mind. Favor defensive REITs with domestic exposure. Consider telecoms as a stabilizer. Be cautious on industrial logistics and China-exposed plays. Watch banks, but don't ignore the risk signals. And remember, positioning beats prediction. Build the portfolio for the path, not the point forecast. What are you looking at this month? Drop thoughts below. Always enjoy hearing how the community is positioning. If this was helpful and you want the members-only checklists, early access notes, and deeper portfolio breakdowns, consider joining the premium community. It supports the channel, and members get first look at strategy updates before the market opens. And if this topic hit home, the next video to watch is my deep dive on Singapore dividends in volatile markets. How to stress test yields when macro turns rough. See you there.